Hi Ganesh, good evening.
Good evening, Mohit. How are you?
All well, all well. Great. Can we start, Ganesh?
Surely.
Yeah, great. So, good evening and welcome everyone, all our clients and investors across the board, who have taken out time to join us today. I think it is pretty rainy evening today, and I think the entire 3, 4 days it has been raining, very heavily. And a lot of our clients have joined us from home. They are traveling. They are, working from their offices, probably, on their way back home. So thank you all, and extremely humbled, extremely grateful to all our clients and investors who have taken out time to join us. And I think I'll start by saying that we have heard this phrase, time in the market beats timing the market. And I think this is very true by saying that the long-term investment journey is pretty rewarding, pretty exciting. And at the same time there are periods of consolidation, there are periods of correction. And I think this is something which is part and parcel of the roller coaster journey. And I think everybody, most of our clients are long-term investors, and we also inculcate the philosophy of building your goals, your long-term ideologies, fitting into your investment journeys. And I think that is where the entire journey becomes more resilient and exciting. And you basically build a wealth creation journey. You are towards trending towards a building a wealth creation journey. So I think, but having said that, last couple of years has been pretty much not that great as far as the financial markets are concerned. We have seen West Asia crisis, the geopolitics, the war, which has been Russia, Ukraine, and US, Iran, and almost commodity prices and interest rates movements here and there, and a lot of things which are not in favor of generally the bulls. And I think that is something which we see that there's a very complex financial landscape in front of us. And I think. Back in Indian markets, of course, we have seen a lot of compounding happening as far as the Indian markets are concerned, because a couple of years back, I remember we had SIP flows to the tune of about 7 to 8 thousand crores monthly, and what it is right now is about 31,000 crores. And I think that is something which gives a lot of confidence as far as one of the better economies across the globe, one of the best economies in terms of compounding stories, in terms of course, resilience as far as the market is concerned. And so to say that there has been concerns which has been raised over the last 1 or 2 years, as far as of course the Indian markets are also concerned, with regards to valuations, with regards to of course the AI story which is there happening in the West, and with regards to the earnings trajectory, the earnings which is over the last couple of years we have seen degrowth in the earnings. And of course it has been slightly better now, and taking better shape now. But I think these are the concerns, including the sector leadership, including it is impacting a lot of portfolios, and how do we create our portfolios across. And I think I can not have a better person who can navigate the entire complex journey, which we have seen. I know Mr. Ganesh Mohan, who is the managing director with Bajaj Asset Management Company. And Ganesh has been working with a lot of institutions across his 30 years, 25, 30 years of career, 3 decades, more than 25 years of career. And I think he has been helping institutions, navigate through this complex financial landscape, and helping them grow, helping them strategize their growth journeys across the businesses. And to start with, Ganesh has let me little give an introduction to our special guest. And so Ganesh has worked with Bajaj Finserv starting with 2015. He worked as joined as a group head of Bajaj Finserv, and helped them in their strategy and the business strategy. And then post that, in 2021, he took over the asset management business. And he has been instrumental in creating that asset management business right from the ground up, and he has built the entire business. What we see Bajaj Finserv mutual fund business today is all thanks to Ganesh and his team. And I think that is where his entire journey has been as far as the mutual fund business is concerned. Prior to that, he spent about 16 years with Boston Consulting Group and helping some of the institutional clients, some of the large, almost 75 institutional clients, financial institutional clients, helping build their strategy, growth, and ecosystem across their financial landscape, and helping them strategize their business, helping in terms of their complex financial landscape as we speak. And he has also been helping the Middle East. He is in the payments services on the payment space as a partner of the Middle East. I think that is where his journey across the globe is also there. And as far as the academic background is concerned, Ganesh, he is alumnus from IIT Kharagpur, and BTech alumnus from IIT honors BTech honors alumnus from IIT Kharagpur, and MBA from IIM Calcutta. And I think he has done an MBA in strategy and finance. And I think who better than you, Ganesh, can be guiding us across through this entire complex, a very very challenging financial landscape. And thank you so much for being and for taking out time, Ganesh. I know you've been traveling a lot, and I think really really great thanks to you to taking out time to join us today.
Thanks a lot, Mohit, for having me on this. I really appreciate it.
Great. So, Ganesh, I'll start by saying, of course, given the complex landscape and given the complexity in terms of the overall financial services, in terms of the global trade dynamics, in terms of the, what is happening in the West, in terms of the geopolitics, how do you see the growth on the Indian financial markets, when it comes to what we see in the valuations and the earnings trajectory over the next couple of years? What are your views as far as Indian markets are concerned?
Yeah. So as you rightly pointed out, Mohit, last couple of years have actually been quite a challenging one in terms of the markets overall in the movement. Right? So if I compare with, let's say, September 2024, when the markets were really at their peak, apart from the mid cap index, the large cap as well as the small cap are probably between 5 to 10%, below where they were at their peaks. Right? Now, that is the price in a sense, right? The key thing that we track is also the earnings, right? Because that actually gives you a much better sense of where the markets are headed, right? Now, if we look at it, the last couple of years, the earnings were a little bit muted. But if I look at more recent quarters, and if I look at this current fiscal year and also the expectations for the next, right? What we're seeing is actually, despite all that has happened in terms of, you mentioned in the Gulf, what's been going on, the tariff wars and all of that, the economy has actually been remarkably resilient. Right? So if you look at power consumption, you look at auto sales, you look at bank credit, you look at GST collections, these have been actually remarkably resilient. So the underlying economy is actually in reasonably good shape. We've had an economy which is still growing at about 6.5 to 7%, real rates, which is close to about 11, 12% nominal. You're seeing bank credit now come back to the mid-teens kind of rates as well, which is supportive of the economy. So as we look forward, we always look at where are the earnings headed, because that gives you the best clue on where the markets are headed. Right? And if I look for FY27 and FY28, we are looking at large cap probably in the 11 to 12% kind of earnings growth rates, mid cap probably closer to 15 to 17%, and small caps in the 20% plus kind of a range. Right? Now, obviously, these are large categories on their own, but what this is highlighting is the economy is quite a diversified one and quite capable of handling external shocks as well. Our sense is, this is actually the last 2 years have been a little bit of a price and time correction, which actually has reduced the risk in the market, actually. So we feel that this is actually a very good time for people to increase their allocation, because what we're also seeing is most of the price movement in the last couple of years was driven by FII flows and the rupee itself, right? The rupee was under pressure, which reduced the returns for FIIs, and with oil, etc., being at elevated levels, the case for India became much more difficult for FIIs. What we're beginning to see, and it's again very, very early trends, is that FII flows have, I would not say have completely reversed, but they're definitely moving in the positive direction right now. So July was, I would say, the first month where the outflows really started stemming, and early signs from August at least are very, very encouraging. So from our perspective, we see it having been a very testing times, but true metal is only forged when you go through fire, right? So that's also a time for investors to show their metal.
Right, right, right. So, apart from of course, the earnings and FI flows, which has, of course, turned positive, and we have seen a lot of, resilience as far as the Indian markets are concerned. There has been a lot of sectors and specifically themes which you feel have emerged out, or maybe like next couple of years, where do you see the growth happening in terms of the sectors, themes, or maybe any specific things that you get excited about in terms of your in terms of your research and your team, which is happening.
Yeah. So we certainly see quite a few sectors that will benefit in the coming couple of years. I think industrials as well as capital goods, given the amount of emphasis that is there on infrastructure, on the order books, on defense, we're seeing significant, opportunities of growth over there. Second, we're seeing significant opportunities in the bank space as well. So we are actually seeing private sector banks particularly very well positioned for growth in the coming years as well. Their credit costs have significantly reduced. Credit growth has started coming back as well. Telecoms, we are seeing ARPUs, significantly rise, and usually that becomes a very good sign for growth as well. And another sector which we are very positive on actually is pharma and healthcare, right? Because it tends to be quite diversified and very I would say divorced from the rest of the economy, right? So it's quite a good diversification play. It also tends to be a beneficiary of the rupee depreciation, right? So among the export-oriented sectors, we actually like pharma. We're not yet that bullish on the IT services space because even though there's been a lot of correction, we've actually been still underweight on that. I think the IT services space still needs to clear its head out in terms of what is the story and how are they going to adopt AI and other disruptive technologies that are hitting the sector.
I want to ask that, yeah.
Yeah, yeah. So I think see when something as big as that disruption comes through, usually it's incumbent on the CEOs, right, to sort of clarify what is the impact, how are they looking to deal with it, how are they training their headcount, what is their model for the future, and what are the numbers that we can expect. That actually narrative has still not fully come through from that sector, and that's I think part of the reason why there's still a lot of uncertainty around how are they looking to deal with this. So till that comes, we are also on a little bit of a wait and watch mode. Um, the other sector we are a little underweight on probably at this point is FMCG as well. So that would be another sector we would be a little bit more cautious of.
Got it. So, as far as the overall, whether it's sectors, themes, and portfolios, what are the specific risks that you see, that can pose some kind of derail in terms of any specific earnings or any specific, themes which you feel there are, or any specific events. We are having a lot of global events which are happening, whether it is divergent interest rates movements across various countries, and how it can impact India in terms of or for that matter, we are also seeing the commodity prices which are looking to be stable at this point in time, but I'm sure 3 years back, we'd seen the Russia-Ukraine war and the commodity prices stabilize, of course, after that. But I think in the last couple of months, a lot of inflationary pressures have been created across across various sectors, and the monetary policy, which is so to say, as far as the RBI is concerned, they are pretty much okay as far as current state of affairs are concerned, as far as the growth is concerned. So are you seeing any specific risks with this kind of a backdrop, or any specific other things which
Yeah.
pose
And I
risk?
think it's a very interesting question, Mohit. What we've seen actually the last couple of years, and particularly even more in the last couple of quarters, even, right? We've seen markets where there's been massive movements within a day, let's say on the equity markets, on the commodity markets, on energy markets, metals, and debt all together in the same day. Right? Now, this is quite unprecedented in terms of the amount of volatility that comes through. That said, the market has actually also been quite reasonable in terms of how it has settled through this period, right? I think the domestic flows have really helped. I would say take up the place of the foreign money, which has which is by and large till June, early July was sort of leaving the market. So I think that stability is certainly been there. I would say the continuing risks, I would highlight probably one external and one internal risk, Mohit, which I think still continue we need to monitor them. The external risk is still the geopolitical risk and the, supply stability around energy, right? I think that is still something which, if this continues for a long period of time, there's no resolution, oil prices, still, continue to be at a higher level. It does put a lot of things at stake, right? I mean, India gets quite vulnerable among most economies on that. So that is one thing that we definitely look at. The second is more of an internal risk, which is usually the monsoon and its progress. That after a very difficult June, I think July has been a good month on that front. But that is still something that we continue to monitor to make sure that on the rural side as well, the incomes start matching and consumption story holds. So these would be two specific risks, Mohit, that I would still highlight. And I would say that volatility we should expect to continue, just because it's very hard to predict the direction, particularly that the US is taking. And one person fundamentally drives a lot of that decision making in a very unpredictable way. So that volatility we expect will continue significantly.
Sure. Thank you so much, Ganesh. Moving back to, I think, US, Indian markets, I think it was a very good insights that you had as far as the Indian markets are concerned. So I'd like to more, know your views on the global markets with respect to what is happening in the West in terms of, Japan, Korea, Taiwan, and of course, US. There are divergent interest rates across these economies. At the same time, we are looking at some of the economies, large economies, slowing down, and of course, in terms of what is happening in terms of the capital flows. Of course, when you look at U.S. yields rising, the capital flows naturally, move back to U.S. And I think the AI story also playing simultaneously. Some of the valuation concerns were there in between. I think, so how do you assess as far as the your views on the global markets
Yeah.
in respect of
So,
that?
yeah. So US itself tends to dominate on that narrative, Mohit, because US itself is close to about 62-63% of sort of the global market cap itself, right? Now, within the US, as you rightly said, rates have been high, and there's probably likelihood of further rate tightening as well. So in that kind of an environment, obviously the risk-free rate from a dollar perspective also goes up, right? What is more likely to happen, what we anticipate, just given the kind of valuations in the tech sector and the AI, I would say in some senses almost over-investment, there is a very strong likelihood of sector rotation, right? So you will probably see significant money rotating out of maybe some of the AI plays, and we're beginning to see that already, and going more into sort of the more traditional consumption, pharma, defense, those kind of sectors, traditional Main Street kind of sectors, not just Silicon Valley. If I look at other markets like Japan and the fact that the US is intervening to save the yen, right, tells you a very big story of how they would like to support the carry trade in yen still, right? So we expect that Japan will significantly benefit as well from this. Markets like Taiwan and Korea have tended to be very narrow, right? So it's usually a couple of stocks that really have driven these markets, right? Now, they've also been highly leveraged, right, in terms of participation in these markets. So that actually creates much greater risk, right, when you have such a concentrated index and there is leverage going into that. Those markets then tend to they can be very very volatile, right, and so it's really caveat emptor at that point of time. um, but that said, I would say the US is really the market that we should really track very closely, just given its preponderance in terms of the weight in the overall index.
So, given let's say a choice in terms of what would be allocation as far as the global markets are concerned, I wanted your views on two things. One is how do investors allocate their portfolio as compared to, of course, a lot of our clients have domestic assets, including in domestic equities and domestic bonds and portfolios across their assets, and some of the assets, if they have to deploy into international markets, a, what are the markets they can look at, b, how they can really build an asset allocation framework around that.
And increasingly, I would say HNI and even affluent customers, Mohit, we see increasingly wanting to diversify away from, sort of Indian assets only. And it makes sense because, India is probably 3.5%, 4% of global GDP. And so you'd want to have some level of foreign assets and also acts as a good hedge against the rupee, right? It tends to predominantly be US, driven. Also, probably because a lot of people, have either family in the US or are preparing the kids to study in the US, etc., or have maybe property and or some business over there as well. So what I would typically differentiate is between those who have potential future needs in USD versus those that are not looking for that and just purely from a diversification play. Diversification, typically we say normally around 10 to 20% is sufficient from a diversification perspective typically. But of course, if you have needs the way you would like to create a corpus, right, and that corpus is for a specific need, those of course you have to deal with a little bit separately, and those would be over and above the 10 to 20% that I talked about.
Got it. Got it. Thank you so much, Ganesh, about that. And typically, any specific, risks that you see in the global markets, or specific sectors where you see outperformance? Of course, you told me about, traditional sectors, where one can look at investing, other than the AI, which has been, I think, overheated, and that particular things are coming down. Any risks that you see across US market and across, other than the AI story, which is overheated?
Yeah. So I think the predominant story, of course, is around the tech and the AI investment. And just to give you a scale of the challenge, Mohit, in the just the hyperscalers, which is the large companies like Google, Microsoft, etc., over the next 5 years are set to invest close to about $4 trillion just in AI and data centers. Right? That's $4 trillion. Now, at some point, some investors are going to be asking for a return on that, right? So if you think about, what is the kind of, profit improvement that is required to demonstrate that, it is very substantial. And right now, there is no revenue model which, gets you that. So either AI has to be priced very differently going forward. Right now, it's virtually free, right? And that cannot continue, which probably will bring some reality in terms of, which use cases will get approved and which will go through. But we see that tech sector will actually see a little bit of a reckoning in terms of what is reasonable versus what is a hype at that point of time, right? So that is really the core, that we have to watch out for, the core risk that we see. The second is really the inflationary tendencies in the US. What has happened is, with the tariffs, and we all have grown up in environments where we used to impose tariffs, right, on goods that were coming in. We were always told on budget day that, TVs will become more expensive when you impose tariffs, right? The same story actually is playing out in the US as well, right? Fuel has gotten more expensive, items have gotten more expensive. So while now they're talking about rewinding the entire tariff issue, but that also creates an economic cost for the government in the US, right? So government finances, which anyway in the US are very I would say very inflationary. Second, they print a lot of money, so their deficits are significant, right, in the US.
Sure, yeah.
And any move towards, sort of de-dollarization actually has them extremely worried, right? So any move, let's say from BRICS or any other, let's say from China or whatever, to move trade away from dollar actually has a significant impact on inflation in the US, right? So that's again a something to really watch for.
Absolutely, Ganesh. I think that brings me to a important uh, question in terms of the commodity, which actually, is driving, the interest rates and the prices, the commodities. So commodities, I would also ask you about that. There's been a lot of renewed interest in a lot of commodity play, which is happening globally in terms of so three things. One is, of course, that you told about energy, which is playing out as a sector. There is precious metals and there is base metals. So these, with respect to what is happening on the inflation in terms of oil price, and of course divergent prices of gold, which gold and silver. You've seen what is the kind of play happened as far as risk framework is concerned. It was going up till December and till January, and I think then we saw a sharp cut in terms of the prices of precious metals. And I think unlike previous directional plays that we have seen, where there is a certain war, the gold prices certainly go up, and this time around it is something which has happened absolutely different. And so what is your view on commodity as a play, when we talk about gold, silver, precious metals, base metals, and energy, per se?
Yeah, no, it's a very important point. I think let's deal with each of these, individually, right?
Yeah, yeah, yeah.
So energy markets, have traditionally been driven by, supply and demand, and who is the supplier at the marginal cost of production, right? So typically that is where the price gets cleared by whoever is able to provide that last barrel, which is priced accordingly, right? Now, what has happened is that has fundamentally changed, right? The moment you have supply disruptions, you have basically a situation where price can be driven by very different factors, right? And right now, I would say it's more geopolitics, basically around Iran as well as Saudi, which is really driving the price of oil. And fundamentally, it's all driven by one person's actions, in this region, right? So tomorrow, if things come back to normal, you could see a very, very rapid move, in oil prices. And if you look at, let's say, 6 month forward oil prices, they're anticipating that some kind of a movement will happen on that front. That things will resolve is the broad direction that the oil markets are giving as a signal. If I look at precious metals, right, I think that's a very different play. So if you look at between gold and silver, right, gold, we typically look at again supply and demand, right? Um, in the case of demand for gold, you actually have much stronger hands than you have typically for silver, right? Gold, the demand has predominantly been coming through central bank buying, particularly some of the large central banks, in the Middle East, in Asia as well. Silver has been a little bit more speculative in terms of the demand and the kind of hands that are buying, which is why you will see that silver has been a lot more volatile than gold as well. So these are some of the things that we keep in mind when we look at our views on each of these areas. Your point also around typically in a war, during wartime, commodities and particularly precious metals should do well, right? This time that has not happened necessarily, because what has happened is this time the war has had an impact on energy prices, right? So the moment governments need to either provide liquidity or save the population from the impact of, let's say, higher energy prices, typically they want to create more liquidity in their own markets. They will not be investing in creating greater gold reserves. So that central bank demand actually reduced at the time when some of the conflict was happening. So that was what really was driving the price movements. But these are again very, very it's a very wide range of actors that really determine
Yeah, yeah,
the
yeah.
price. Yeah.
So, as far as, base metals are concerned, I think there is a different play happening. Industrial play, and so are we seeing some kind of a uptick in the commodity cycle in terms of gold, in terms of silver, base metals, or it is a prolonged cycle that you see happening, or with respect to certain things which are getting unfolded as far as the commodity cycle is concerned, or as far as
Yeah.
the requirement around some of these. Of course, the requirement for all of these commodities is absolutely different. You rightly said about the energy requirements. The gold requirements is coming from the central bank, and de-dollarization, and some of the hedge that it creates across inflations and other things. And of course, silver is more to do with industrial use, more to do with semiconductors and EVs and batteries and solar panels, etc. Are we looking at some kind of a prolonged uptick as far as the commodity is concerned? I mean, just your views on that.
Yeah, we're actually very positive on the commodities space overall, Mohit, and we see that the commodity cycle actually is beginning to turn, right? For both, I would say, precious metals as well as for base metals, more importantly, industrial metals as well. What we are basically seeing is significant growth in construction, manufacturing, capital goods, industrials. These all typically require quite a lot of base metals as well. Second, what we're seeing is this is a significant area of growth where some of the rare earths, the construction that comes out behind that, there is significant amount of demand side. There's a lot of aspiration from each of the countries to start controlling their own supply chains, right? Nobody wants to be purely dependent on China as a supplier or the US as a sole market. So they're trying to create greater self-dependence when it comes to metals, the key things that keep the economies growing, right? So that creates also a certain amount of demand, right? Which we see as something which is going to drive a major commodity cycle going forward. So we are very, very positive and bullish about this.
So, let's say if we were to deploy, some kind of allocation towards commodities, what I mean, how much percentage, and what are the ways we can play this commodity cycle? If you can just give us
Yeah.
views on that.
Yeah. Again, I would differentiate more between somebody who's doing this purely as a hedge or as a diversification instrument versus somebody who's wanting to have a pure commodity kind of an exposure, right? And each could be very, very different, right? Typically, from a hedge perspective, we typically look at between 10 to maybe 15% is usually the amount that we would recommend from a hedging perspective. Now, traditionally, gold and silver have acted as sort of counter-cyclical to equities, right? Not necessarily the case this time, but this time actually quite a few things have been quite different. But 10 to 15%, I would say, in gold and silver is probably a good sort of a diversification hedge to have. I would actually not recommend having significantly more than this. And the reason why I say that actually is because there have also been extended periods of time when gold may not do well, right, or may not really sort of grow beyond, let's say, a 4 or 5% kind of an annual growth rate. So we've seen that the last 20 years, if you take a 5-year holding period, there have been about 25% of times when gold, if you had a 100% gold portfolio, you would be returning less than, let's say, 6%, right? Which is less than, let's say, an FD, right? So there are times when gold suddenly will do well, and there will be extended periods of time when it may not. So it's actually good as a diversification hedge. Somebody who wants to take a very strong concentrated commodity call, I would say it's a very highly risky, sort of a bet at this point of time. Much better to sort of keep it within certain confines.
So, of course, when we're talking about the global markets, I forgot to ask you a very special question in terms of the how much one can look at investing as far as, I mean, as a part of the portfolio diversification, or as a part of the portfolio asset allocation. How much one can look at in deploying in, let's say, international markets. Of course, you have US as one of the and favorite markets across the globe, and followed by some of the other Asian markets. So what can be the percentage allocation of the percentage of the portfolio?
Yeah.
one
No,
can
so
look at?
we absolutely, I think we discussed this as well. What I would recommend typically would be not more than 20% if you're looking purely from a diversification perspective. And if you do not have any planned commitments, as in if you have a child that is going to go study over there, of course, then it's different. But if you're doing this purely as an investment, as a diversification, and sort of a rupee hedge as well, 20% is probably a good number to sort of start with and slowly build your exposure, right? Because these are also markets where, at the current levels, there can be significant volatility there as well, right?
Understood.
So it's something which probably needs to be done a little bit more gently, if you want to increase beyond that.
So Ganesh, a lot of our clients have allocations towards mid and small cap space, right? And as a part of the asset allocation framework, what would be your advice or your views in terms of course, how important it is to build a strong, resilient portfolio, an asset allocation framework. And I want a little more detailed views on the asset allocation framework,
Mm.
because I think that is what probably one has in the last couple of years, what has been safeguarding the investors is, of course, the asset allocation and how important it is, and little more views on that. And the equity, the debt, the bonds, and the gold, and the overall asset allocation framework. How can one play if somebody has to invest, let's say today?
Yeah. So if I take a look purely from a market cap perspective, Mohit, right? Large cap would typically be around 70% of the market, mid cap maybe 20%, and small cap would be close to around 10% of the market, right? But if I look from a growth perspective, right, earnings growth in the large cap space will be probably around, as I mentioned, 12%, mid caps maybe around 15 to 17%, and small cap more than 20%. So what we recommend to people is, while the market caps are one thing to look at, what your objective, if your objective is growth, right? Clearly, you need to have a slightly higher share in the mid as well as the small cap space, right? If you take a look at, for example, from our flexi cap perspective, where we are allowed to invest across all three categories, our ratio would be closer to around 45% in the large cap space, around 20% in mid cap, and around 30% or so in small caps, right? So that's typically the approach that we follow, that we try to have a slightly higher percentage in some of these categories, so that gives you the opportunity for higher growth, because that's really what people are looking for in their equity portfolios. That said, small cap comes with higher risk as well, right? And it's important that people should recognize that. And which is why, it's important to have, a good set of, or a good understanding of what are the governance risks, which companies you're investing in. And this is better done through, professional fund management than individually trying to get that, because it's very, very hard to have the kind of forensic analysis at an individual level to be able to do all of this. So what we typically recommend is this kind of a structure if you're looking purely from the equity perspective. The allocation across other asset classes, actually, we follow a two-step process, Mohit, right? First is we actually take a look at what is the money that you need in the next 1 year, right? Which could be immediate liquidity, anything that you need in terms of spends, etc. That we typically would park in something like liquid or arbitrage, right? Anything that you need, let's say, and you know that you will need this in the next couple of years or maybe 2 to 3 years, those typically, and if these are known spends like child going to college, or there's a wedding in the family, etc., those we would actually recommend having some debt funds to support that, right? Because there again, you don't want to take too much of a risk on the principal itself. Anything which you do not need over the next 3 years, and where you can allow it to compound, you don't need to take immediate action if the market corrects by 5-10%. That is the money that you should be bringing in and thinking about an overall asset allocation across different asset classes. And there our view would be, closer to a 70%, sort of equity, again split between large, mid, and small in the proportion that I talked about. And then the remainder portion, you can actually split as maybe around 15 to 20% debt or 15 to 20% commodities, depending on your risk tolerance and goals. Right? So that's broadly how I would see the asset allocation discussion.
Uh, Great. Just one advice, Ganesh, for some of the investors who are beginners. What is your advice for a investor who has just started his investment journey, how can he look at allocating for 5 years, 10 years,
Firstly, I would say congratulations for starting your investment journey. I think that's the best decision that you could make. We all hope that you do it as early as possible, right?
Right.
So I have 20-year-old children, so I tell them that you're actually the best place to start your investment journey, and that gives you the time to compound, right? But suppose somebody who is, let's say later in life is just starting their investment journey, right? And if they have, let's say, 5 years to really think about where they would like to deploy, I would still say that the Indian markets actually give a very compelling argument at this point, simply because the risk has come down significantly. If I look at today's valuations, today's PEs, we've gone through a time and price correction over the last 2 years, right? And earnings have been growing as well. So the valuations have become much more attractive at this point of time. I would say a good mix in terms of a balanced fund between your large, mid, and small cap. Typically, a flexi cap kind of a fund, is a good approach for people to start if they have to just pick one fund, right? And I would say a flexi cap with a reasonable allocation to mid and small caps, right, is probably one that they should start their investment journey over the next 5 years. And as they build their comfort and confidence in this in investing itself, then they can consider other categories as well.
Ganesh, a lot of our clients are, the investors who have been investing through last couple of years. They have had been, of course, investing into various asset classes, including domestic equities, international equities, gold, and fixed income, within equities, mid and large cap, small cap space, and all of that. Just give us a piece of advice of when to rebalance some of these portfolios and staying invested versus profit booking. And I think we get a lot of these questions across from our clients. We need to book profit, and do we really need to book profit, or we need to stay invested? I think these are some of the questions which often comes from a lot of investors who are investing in the mid of their journey.
Yeah. No, it's a very important and good question that you've raised, Mohit. The way that we do it is we do it through the asset allocation approach, right? So I'm sure you'll be having asset allocation discussions with all your clients, and I'm sure many of them have a very clear perspective of how to build that as well. My own approach on this is don't tinker too much with that, right? Set it basically once, and this should be typically okay for the next 4 or 5 years. Do an annual review though, right? To see how are you doing, because some asset classes may have run up a lot in the last 1 year, some things may have not, may have corrected a lot. So what could happen is within a period of a year, you may have certain things which are outside your asset allocation corridors, right? That is actually the right time for you to take the decision of should you do some profit booking to bring it back into the corridor, or maybe put in incremental investments, right? I would much rather do it through the asset allocation rather than trying to take individual calls at different points of time to say that, oh, now this looks overpriced or now this is significantly corrected. Because then you're taking individual calls, which is much more difficult to do versus a more systematic annual sort of a review.
Got it. Got it. So I think this is one of the most balanced approach that we have taken. And as far as the investment journey, I would, Ganesh, have a lot of questions from our investors. I think I'll just take step by step couple of the questions which we have. So one of the investors is of course asking, how do you currently see the asymmetry between the energy transition demand, especially copper and critical minerals, and the strong cash flows that's still coming from traditional energy?
Hmm. So what I would say is, this is a question around multiple commodities, right? And
Right.
each of these has a very different approach because there is one which is more on renewable energy and one which is more traditional energy, right? Now, renewable energy, my sense is set for a massive period of growth in the coming years, primarily because you're going to see a significant support from different governments that do not want to rely on traditional energy sources, traditional energy suppliers anymore, right? So you're going to see a significant push that will be coming in, some of the rare earths, some of the solar panel manufacturing, electronic manufacturing systems. Many of those industries will actually be significant beneficiaries, right? Now, in the interim, it's still hard to get away from traditional energy. So it's a transition that is definitely going to take place. But we see clearly that in 5 years' time, the proportion of renewables will be significantly larger. And that has, of course, associated impacts across the entire value chain. So we're seeing, significant energies, investment in green energy, in hydrogen cells, and so on and so forth. This will only grow in the future. So we're definitely investing in those.
Great. So the second question, of course, we discussed about the asset allocation within Asia, global debt, commodities. So anybody deploying the fresh capital split between India, Asia, global, and debt and commodities? Any specific views on that?
Yeah, so I would say overall, I would say if you don't have any specific commitments that you need to deploy in any individual market, I would say typically the equity debt to commodity should be ideally a 70-15-15 kind of a split. Now, the equity itself, you could say, typically around 20-25% of that could be in foreign markets or global markets. That's something that can be considered. The remaining portion, I would say, typically deploy in a flexi cap, which is across different cap categories. Um, Debt is actually an instrument which many investors tend to ignore, right? And it's something which
And I
has a
think that is very important as a part
it's
of the
extremely
portfolio.
important, and I would
Risk mitigation in the portfolio, I think.
very much, very much. And so we keep reiterating that debt has a role to play in every investor's portfolio. During bullish markets, people tend to completely ignore it. It's
Yeah,
very natural, but it's important for us to keep highlighting that this has a role to play, and people realize the value of debt only in times when the markets are not doing very much, right?
absolutely,
So
absolutely.
it helps to diversify and reduce the risk in the portfolio.
So, one of the questions which has come from one of our clients over here is what should the investor position, how should the investor position their portfolios in the current environment with respect to growth, value, or balanced approach?
Yeah. Um, I would say, people should take a more commonsensical approach rather than try to go to a style, right?
Right, right.
If you're in a market, right, without growth, it's meaningless, right? You're certainly looking for growth. You
Absolutely.
want to invest in good quality companies, right? You would not obviously invest in weak or poorly run companies. And you would not want to pay, very high prices for it, right? So what we keep telling people is you want to have a good mix of all three. Right? It's not about either or. It's actually about what is the right balance that you're able to find. Right. So that's something which people need to keep in mind. That India is a market which actually gives them opportunities to do all three together. Right. You don't have to sacrifice one or the other.
So, Ganesh, there is one question around FCNRB deposits. We have actually seen in the last few months, since the time this Government of India scheme has launched, various banks, the FCNR deposits have, I think, significantly taken the leap on the upside. I think $40 billion have come
Yeah.
out. So, there's a question: do you believe the current preference of FCNRB deposits over India-focused mutual funds is creating a meaningful headwind for domestic capital markets and its impact, with the limited period it has?
I wouldn't necessarily say it is only the recent preference, right? Because the government obviously wants to get in your dollar denominated deposits to be able to shore up its own options to be able to defend the rupee, right? But I think what they have done by sort of doing, changing the taxation structure for longer term debt actually has had a negative impact on creation of deeper debt capital markets in India, Mohit, right? On the one hand, we say that we want deep, capital markets, but then there's no incentive for anybody to invest in longer term debt, right? If you're investing in long
Right.
term equity, you have a taxation benefit, but investing in long term debt does not carry any benefit, right? So that actually is something which is I would say, an anomaly, right? That we need to correct. Like, for foreign investors in guilds, they've taken away the long term capital gains. I think this is something which the government should probably consider to spur a deeper debt market in India. Otherwise, it's going to be very difficult.
So, one of the questions is coming in my mind with respect to debt market is, of course, the yield curve, the interest rates, and rupee, because stabilized rupee is very, very important. That's what the FCNRB deposits is doing, and the removal of the capital gain tax for the FPIs is also to help stabilize rupee and get more flows. So what is your view on the interest rates and the rupee going forward, and it's over the next couple of years?
Yeah, I think it will be predominantly Fed dependent, Mohit, right? If let's say the Fed raises rates, and there is a pretty strong likelihood that that might happen in the coming 6 to 9 months, the RBI will probably also have some, sort of its hands will also start getting forced a little bit more on that front, right? So far, it's been sort of data dependent. It's taken a much more of a dovish tone. But as rates rise in the US, it becomes more and more difficult for RBI to keep the current rates, right?
Right.
So I think that is something which we certainly see as a potential risk. In terms of the opportunities, we actually see more in the shorter term, sort of in the 1 to 3 year kind of maturity bucket. We actually see certain opportunities over there. So much more in the lower end of the curve, just given the kind of mispricing that we see in the yield curves today.
Understood. Understood. So I'd have to take some more questions, Ganesh, before we wind up, because we are having a lot of questions from our clients over here and investors over here. And why not? I think we have somebody like you who is answering. I think it is something very, very heartening. So there is a question which has come from one of the investors. How do you see AI and digital transformation influencing investment opportunities in India over the next decade?
Very interesting question. So, the traditional view is, AI is India is not a beneficiary of the AI play, right? We don't have the large language models, we don't have the chips, we don't have the technology, in this space, right? But I think there will be several areas where we will be very strong, appliers of AI, maybe not the suppliers of AI, right? We are beginning to see that, for example, in our own group company, right? Bajaj Finance has, a plan basically to deploy close to about 10,000 crores of AUM. You will get built up purely through this is loan business, which is going to get done completely end to end through AI, right? There will be a lot of such business opportunities that come through that. Similarly, on the data center side, right, there is significant opportunity that India will actually benefit from as well. Second, AI will also spur significant amount of demand for devices as well. So electronic manufacturing systems, these will see secondary benefits as well. Construction will also see significant benefits. So we see a set of themes around AI, not maybe necessarily just the AI itself that India will significantly benefit from. And our sense is that some of the IT services players will over a period of time also figure out how to play in the space, right? There will still be requirement for IT services. I'm fairly convinced that you're not going to suddenly hand over mission critical systems to an agent that you never that you have no control over, right? Tomorrow, just because it exists, right? With
Right,
no
right.
recourse to anything to address, right? So there is I would say a lot more that IT services companies can still do. So there is a role for that as well. So I think India will actually net be beneficiaries in this. Any new technology requires people to help companies address, bring that in, make it and develop it at reasonable cost, right? So that opportunity will certainly be there for India.
Great, great. So there's another question with regards to some of these structural themes that investors are looking at. Maybe they can look at that are underestimating. Some of the structural themes that we can look at that are currently not, kind of probably we are underestimating. One of the questions has just come. If any specific
Themes that
structural
we are
themes,
underestimating today.
yeah.
Um, That's nothing immediately actually comes to mind, to be honest, Mohit, on this, because the market tends to actually be pretty good at identifying these kind of big things and pricing those in.
Got it.
So I would not say there's anything major that is completely I mean you could have things like data centers in space and stuff, but that's hard to estimate at this point.
So, how do you think about the pharma sector right now relative to other domestic defense or other growth sectors?
Yeah. So pharma, I would say standalone itself is a very attractive space that we find very interesting. Of course, pharma is a very very broad, this thing all the way from hospitals, diagnostics, labs, APIs, CRAMS. There's many subsectors in there. What we're seeing is with the US, enacting the Biosecure Act, with the rupee depreciation, these all tend to be, India tends to usually benefit, right? On the APIs, we are one of the lowest cost manufacturers. Our view is very positive on this space because we are seen as one of the beneficiaries over here. I would say there are other sectors like defense as well. You will see significant growth because there is going to be a lot more indigenization, a lot more sort of focus on how do we build defense supplies, etc. And India, I think, being a more neutral provider, right, is actually well positioned as well. So we see multiple sectors, sort of that can benefit. But pharma and defense, we're both positive on.
Okay, great. So there's one question around given the current market valuations, what would be the idea or recommendation to the investors? Continue with the staggered fashion investments through SIPs and STPs, or this is an opportunity to kind of deploy some kind of fresh lump sum capital in,
Hmm.
this point in
Yeah.
time?
So I would say that the traditional approach, usually whenever the markets are very volatile, is to usually have a staggered approach, right? Because it's very hard to precisely time the market, and customers who are unwilling to sort of bear too much volatility, investors, I would recommend them to come through the STP kind of a route. Um, Higher ticket investors, those who have comfort in the market, who've seen this level of maturity in the markets, and who are willing to, let's say, work with maybe a 5 7% kind of correction from here onwards, and they're comfortable on that. For those kind of investors, even lump sum is not a bad option at this point of time, because primarily because a lot of the risk has really come out of the market.
Right.
So while of
Right.
course you can always see a 5 10% move down from here, anything is possible. Chances of that have significantly reduced.
Got it. Got it. Uh, one or two questions I would request you to also answer. In terms of the geopolitical uncertainty, it becomes a new normal. How
Hmm.
should long-term portfolios evolve as compared to last decade? Can we consider this as a new normal and design our portfolios looking at the geopolitical uncertainty?
Yeah, the one thing I would tell people is there are some things which are almost timeless, right? Being disciplined in the markets, doing regular investments, making sure there's a diversification, having asset allocation. These things don't change, right? They're probably true 100 years back. They will probably be true 100 years from now as well. So those principles, I think we should definitely adopt and make sure that we are following, right? Now, from time to time, there could be certain sectors or certain allocations or certain themes that we want to adapt a little bit to, right? That's perfectly fine, right? Um, but I don't think this is something which we need to necessarily react to market headlines every single day. As long as you have something which you're reasonably comfortable with, I would say investment should be a little bit like as Benjamin Graham said, watching paint dry, right? It's perfectly fine to let it do its job, let it compound over a period of time.
I think patience, and resilience pay in long term. I think stability, patience, resilience,
Very
and
much.
consistency actually pays a lot. It pays a
Yes.
lot in long term wealth journey. Ganesh, there are a lot of questions, but I'd not take a lot of them because we are having the paucity of time as well. One question which has come then. There are so many mutual funds available
Hmm.
in India today. What is the simplest way for a beginner to decide which fund is right for them?
Hmm. I think the first thing that you should do is obviously speak to your advisor, right? If you're trying to do this entirely by yourself, it can become difficult, and sometimes you may end up with the wrong conclusion. because most investors that we found typically tend to go with either past returns or AUM size. And I can give you 10 reasons why that can be the wrong framework, right? It sounds very logical, but it's definitely the wrong framework. What actually makes sense is to invest in those funds where you have conviction that they're doing something which is, let's say, if you're taking an active equity fund, it actually has high active share, right? It has a strategy which can beat the benchmark or can at least aspire to beat the benchmark. And it is run by a team that has done this before, right? These are typically the things that you want to look for. And I'm talking only about active equity funds over here, because that's, I'm assuming, where the question is coming from. Very, typically actually your fund decision should be ideally the last decision that you make, right? The first decision is really about your asset allocation, your risk tolerance, and what your objectives are. Usually, most people I find don't do that very well on their own unless they're having a discussion with a thought partner,
They
right?
directly make the fund decisions.
Exactly. People jump towards the fund decision and want to get to that conclusion. To me, that is the last step of the journey.
Right. I think it was very, very insightful, Ganesh. Very interesting and I mean, an amazing conversation. I think I've had a lot of things taken home back today, with our conversation. One book which you'd like to recommend to all of us and our clients, which is related to probably, we can read, give us little
Yeah.
help on the markets and a little
There's
otherwise.
a very interesting book, Mohit, called Thinking in Bets. It's a book written by somebody called Annie Duke. Now, interestingly, she's a poker player.
Oh,
So it's basically about how do you place bets on an uncertain future, right? And there's a lot to learn actually from that. And in life, many of our decisions are basically about placing bets when you do not know the future. And definitely in investing, that is often the case. So how do you make those decisions, right? And how do you expect, how do you sort of trade off the risks and the rewards in each of the decisions that you make? I think it's a fantastic read. I would definitely recommend it to you and all your investors.
thank you so much, Ganesh, for taking out time and talk to us about the entire complex navigation of financial markets and giving us, your views on various global Indian markets, global markets, commodity markets, and the debt markets, and of course, create how to create some of the resilient client portfolios and build long-term wealth. And I think your words of wisdom is, we really grateful and thank you for your time and that you've spared. I really thanks to all our investors and our clients who have taken out time to listen in, and of course so many questions. I think still some of the questions are unanswered. I'm sorry. I think Ganesh, I'll text you all these questions.
No, no,
I
please,
would
please do. I'll be happy
request.
to answer all the questions. We can do that maybe in a separate forum as well. And I would definitely say thank you very much, Mohit, for inviting me. I really appreciate the conversation. And I wish you and your investors the very best in your investing journeys.
Thanks a lot, Ganesh. Thank you so much. And wishing everybody safe, healthy, and happy investing, healthy evening, safe evening. I think it's been raining still, I think last couple of days and still. So thanks everyone. Thanks to our investors and clients, and thank you so much, Ganesh. Thank you.
Thank you.
Thank you.